Another year has flown past quickly, and here we are once again, all set to celebrate the Festival of Lights. Welcome to the Money 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 Diwali special, and let me start by wishing all of you viewers out there a very happy Diwali and a prosperous new year. The last 12 months have been quite an eventful journey. A credit market shakedown, a new government, a slowing economy, and rapid response both from the RBI and the government in the form of interest rate and tax cuts. It's been quite a heady cocktail for the financial markets. Now, through all of this, while the equity market has managed to generate an 8% return on the Nifty, fixed income has proven to be an absolute roller coaster. Smart 15 to 17% returns on gilt funds, would you believe it, on one hand, and volatile returns for several credit and corporate bond funds on the other. And then there is the age-old asset class that's been a traditional favorite for all of us Indians, gold. Yes, the yellow metal has indeed sparkled this year with a near 20% appreciation. Now, that's the year gone by. The question as we get set to welcome Goddess Lakshmi this Samvat is where and how will money be made in the coming year? Which asset classes will outperform and which are the ones that may still continue to struggle? Will markets continue to be volatile? And if yes, then how should you approach your investments? And most importantly, what are the key lessons to keep in mind when it comes to risk mitigation and capital preservation? Well, joining me on this very special edition of Money 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 are, some of the names that we know so very well. They come in from the wealth management, asset management and wealth creation platforms of the financial markets. Swarup Mohanty, the big boss at Mirae Asset India. Swarup, thank you so much for joining us on Money Money Money. Kalpen from DSP, pleasure to have you in our studios. Thanks for joining us and season's greetings. And Ashish Shanker from Motilal Oswal Private Wealth, an old friend of Money Money Money. Great to have you gentlemen joining in. First of all, there's been so much of gloom and doom talk. Let me ask you, are you feeling festive, cheerful? Does it feel like Diwali to you, Swarup?
Yeah, I think we look forward to this Diwali as a turning point in the gloom part of it. You can look at it in two ways. One is there is gloom, and the other part, the growing transparency in the market. There can things happen, but it will come out into the open, which is the new age of communication, and that's a welcome change. You know, a known risk is better than risk which is somewhere buried and we don't know. That's the way we would like to look at it.
I like how you're sort of lacing it with a sense of optimism and hope, because Kalpen, it's been a rocky year, right? Because ILNFS started back in September last year, and here we are 1 year down the line, and the aftershocks, the after effects are still being felt.
So, for those who are invested, it is a rocky year, but if we look at consumers in India, barely 10% invest in equities or even in mutual funds. So 90% are yet to come, and for them, this is good news, because all the frothiness of the market is giving very attractive opportunities to invest. So for me, that is great Diwali. Investors for the future are happy that they're getting prices after a long period of time. So अच्छे दिन आ रहे हैं.
Achhe din aa rahe. Okay, we can all do with some more achhe din, because I'm guessing, Ashish, you would have been dealing with harrowed clients throughout this 1 year, talking about why returns are not coming, why there are accidents in certain funds. Your thoughts?
Yes, it's been a challenging year from an investor point of view, because you had so many accidents in the portfolio. However, one needs to keep the time series in mind. We always look at it from a 3-month or a 1 year angle. But if you look at the last 4-5 years or 6 years, I think for our industry, we've been big beneficiaries. I mean, mutual fund assets are now closer to 26 lakh crores. More and more people are putting their money in financial assets as opposed to physical assets. The wealth management industry has grown. So yes, last 1 year has been challenging, but really I don't think we should be complaining. I mean, if I look at teams of the wealth management businesses, I think they've grown about 3-4 times. If you see the advisors and if you see the sheer number of clients. So yes, last 1 year has been challenging, but I don't think we should be complaining. We should take these kind of years in our stride.
Before I come to investors and investments, actually that's an interesting point. And how's it been at the office for you guys? I'm sure there have been plenty of sleepless weeks and nights, and especially for all the fixed income fund managers out there that are part of your teams. Swarup?
Yeah, I think for us it's been a very different year, and we did aim for a substantial market share as we speak in the sales sort of parlance, not exactly in the right frame of asset management, that played out, because if you go back to 2016, we exited the mid-cap market. That was a call from us. So from 2016 to 2019, the monies which have come to us has been primarily large cap. So we've been isolated from the pain.
And that worked really well for you, because mid-caps went through the pain.
Call. And then we re-entered the mid-cap market only 2 months ago. So we remain isolated from that pain or underlying. But having said that, if you look at the 3 years of mid-cap, which we define as pain, is the way that segment is. You will have 2-3 years of these kind of pains, and suddenly they will rebound in 2-3 years, coming 2-3 years. And I'll echo what Kalpen says, the investment experience of people who for the next 3 years will be probably very different from the last 3 years. And people who stay that entire 6 years will probably benefit the entire part of it. And then see, from the debt perspective, we are actually a bit small to really make any comments, but to be fair to the fund management, we remain isolated there. So I think office has been good. It's been a good year for us. We are not complaining.
Considering the environment, I get that. So before we talk about more of the details in terms of the investment outlook, just again the throwback, because Kalpen, we've spoken through the last 1 year as well, because there have been accidents, and then how do you ring fence your investors? The whole example, whether it was DHFL or certain other entities that defaulted, what would you say are the lessons learned here, and then have things stabilized on that front?
So I think any year of volatility like this goes wasted if we don't reflect and learn and strengthen our investment approach, our attitude towards risk. So I think the biggest lesson in the last year across all asset classes which reflected volatility is to start by thinking, where can you go wrong? And if you can envisage where can you go wrong, try and ring fence that. So from our perspective as asset managers, our whole approach is to recognize and respect risk very transparently and communicate that more effectively. So that there is complete alignment and investors know what they are seeking. Largely, we like to buy returns. However, when we buy past high returns, what we receive is risk, because these are cyclical asset classes, good times and then bad times. So gilt funds up 17, and there are years when it is, -2.
Yeah.
So what's important is, we articulate investment frameworks very transparently across every style and asset class.
Sure.
Educate our investors. It's a very slow process. It's not very easy, because on one hand, if returns are flying, you want to cut your check and invest rather than understand what's the philosophy and what's the process.
Risk and what's
so the approach I think that we continue to strengthen at our end is first of all ourselves ring fence risk better, strengthen our processes, look at turning points, cycles differently, and then articulate and communicate more objectively and transparently.
Okay, that's reflections on the year gone by, but it's all about looking forward into the future and being positive about what the possibilities are out there. So where can money be perhaps made in the next 12 months? That's going to be the focus of this conversation. The asset class mix, physical versus financial assets, equity funds, debt funds, the whole conversation coming right up after the break. Welcome back. You are with the Diwali special edition of Money, 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 and we are speaking with industry veterans, representatives from the mutual fund world and the wealth management world about where money perhaps can be made in the new Samvat. So Ashish, this question goes out to you. I think this is a year that really takes us back to the drawing board, right? The good old principles of financial management, personal finance, sort of basic rules, asset allocation, risk mitigation. It's just going back to class, isn't it? So starting with asset allocation, looking at the volatility and the turbulence around, what are you telling clients right now?
Yeah, so just to expand on that, I always say that, market teaches you the same old lessons in new ways, and that's exactly what has happened last year. What we have learned is the age-old lessons that you need to be diversified, you need to focus on your asset allocation, and you should not be chasing returns, like Kalpen mentioned. Looking forward, I mean, of course, asset allocation is a very personalized thing, and it depends on the individual client's risk temperament.
Sure.
But just to let's say gaze into the future, and it's not just 1 year, I'm saying over the next 3 years, the asset classes which look good to us, one equities definitely have come off quite sharply. I mean, most people focus on the Nifty, and there are few stocks which have kept the Nifty afloat. But if you look at the larger market, it's actually very, very reasonable. There is a lot of pessimistic news, and the outlook is also very negative. Normally, this is a very potent combination for equities to do well into the future. Second asset class which I think is looking very attractive is gold. And
it's amazing. You do not say fixed income, you straight away jump to gold. Now, that's a departure from the usual norm on every Diwali special that we do. Please carry on.
Gold is normally a protection asset class, which means that you're trying to hedge against uncertainty or against any global calamity. If you look at the way the markets are evolving around the world, there is a slowdown happening. Your bonds are trading at negative yields. There is something which is not right about global markets at this point in time. So as a result, gold becomes attractive, although I know last 1 year gold has done extremely well. But from a diversification and from a hedge point of view, I believe that every portfolio should have some gold in it. In fixed income, again, we believe that
What's your definition of some when you say some gold? Because that's usually a point of debate, 5% more right now.
5% doesn't move the needle. I mean, if you really want protection and you wanted to move the needle, I think you need to have minimum 10 to 15% in your portfolio.
Wow.
And you have to look at it as a hedge, because as an asset class, it doesn't move for 3 years, right? But in 2 years, it catches up the returns for 3 years.
Okay.
So that's how one needs to view it. But if you want to have a meaningful impact, to have a meaningful impact, then you need to have 10 to 15%.
That's quite phenomenal. I don't remember the last time we had a wealth planning expert on the show recommending 15% exposure to gold. In fact, we're going to get our commodities editor Manisha Gupta in just a minute. She will talk about all the driving factors that have led to this massive surge in gold prices in the last 1 year. But let's come to the asset class that we all know the most, talk about the most, equities. And here's the thing, I also want to get your reaction, like Swarup just mentioned, that they were out of mid-caps completely and now they've entered. You made the same point, that the broader market is looking more attractive. In terms of fund recommendations, are you preferring your clients to be in multi-caps? Or large and mid, totally mid, small? What side of the market are you looking at?
So the space we really like is the multi-cap space, because it's not necessary that all small and mid caps do well just because they're cheap. Mid caps don't do well because they're cheap. There has to be concrete triggers, and it's not necessary all the small and mid cap companies do well. So I think it's best left to the fund manager to decide how much to allocate to large, mid or small, and it gives you a nice reflection of the broader market, multi-cap funds. So we like the multi-cap funds very much.
Okay, so now we come to my favorite part. Every time I have mutual fund bosses on the show, I always ask them where they would put their money if they were to deploy their own personal wealth. So Kalpen, let's come down to, you can of course choose from a universe of your own funds. And also whether you would go with the other panelists, would you look at mid caps more than large caps right now?
So I'll just extend to what Ashish mentioned. I have learned this, and this is what I tell everyone, that don't frame your investment objective by saying I want to invest in large, mid or small companies. Rather frame it as saying that I want to invest in good companies. That I think will help investors contextualize their wealth creation journey much better, number one. Number two, for example, we have a small cap fund which we stopped taking flows in 2017. And we still have not started taking flows there. We only take money through SIPs. And while I acknowledge that prices are down 25 to 35% in the small and mid cap universe, but when I look at our own portfolios of small and mid caps, for example, the portfolio valuations are somewhere around 30 times. And the same companies, if we had held 10 years back or 5 years back, their lowest valuations were 12 or 13 times. So are good companies cheap? The answer is no. It's ideal when good companies are cheap, but that comes very rarely in a phase of crisis. So keeping that context in mind, I also agree that buy good companies across all market caps. And there is another evidence that generally only 10% of small cap companies eventually become large. Right, so you need to be very particular of what you eliminate and what you not own. So
okay, so your fund, because we're a little short on time as well. Where would you put your money?
My exposure, one, by mandate only DSP funds, number one. Number two, my asset allocation right now is 60 rupees in Indian equity mutual funds, around 10 rupees in US fund, around 12 rupees in gold mining companies fund, and the rest is in fixed income.
The rest is in fixed income. And within the equity universe, which DSP fund would you park your money?
So I have 3 funds in which I have my money. I have the DSP Equity Fund, which is a multi-cap fund. I have a rules-based fund which codes for investment principles, so that's called the DSP Quant Fund. And I have recently invested a bit in DSP Nifty Fund.
Okay, there you go. So now we have it. It's all on the table. How Kalpen is looking at managing his wealth in the year and the years ahead. So, same question to you. You did say that now, as a fund house, you're dabbling into mid caps. Where are you convinced?
Yeah, I am a very boring investor when it comes to investing. I follow that same age sort of thing, which is age is your equity, but I am an aggressive investor, so I add age plus 15 to my equity part, and I am an equity debt guy. I don't, see, we come from the East, okay, where the gold in the house is, you know, we can talk about, forget the women wearing gold, the men also wear enough gold, so there is enough gold.
That's already there, asset allocation is done.
But the thing to learn from gold, and it's a very interesting thing, if you look at the investment behavior of people, in gold is something which we need to imbibe, whether it's equity or debt. Look at that. I mean, some financial advisor sometimes in history has said that here is a metal which is actually useless, and it's a precious metal. So we accepted that. Then that same financial advisor has given an SIP date every year, right? There is an Akshaya Tritiya where you buy, okay? And then it's a commodity, so it's demand and supply. On that day, your demand is very high, and so your prices will be the highest.
So that financial advisor has been, I think, our grandmother, mother's grandmother, through the generations.
Now here, when it comes to mutual funds, we are talking about SIP for 2 years, 3 years. That's an SIP for generations.
For 50 years, 100 years.
My grandmother used to buy, my mother is buy. I hope I don't buy more. But if you imbibe that same philosophy
in equities,
in both these asset classes, you are bound to make money. Nobody is bothered whether the price is highest on Akshaya Tritiya.
So in terms of funds,
yeah, see,
what would you bet on?
I've been very happy and very lucky to have invested in Mirae Asset for the last 8 years of my investing, and touch wood, I think the funds have done well. On the day Nirmala Sitharaman made her call,
the tax cuts,
I gave a call. I wish I had a gilt fund. That day I invested in his gilt fund. so you see, there is so much of money worldwide at 0%, and our tenure is 6.71. One of them has to have to be wrong, right? And even if they merge somewhere midway, that call of mine will not go wrong.
Since we spend so much time talking about gold, the debate for and against it, let's get our commodities editor Manisha Gupta. She's been tracking this stupendous rise over the last 1 year. And more importantly, the question is, are people betting on this rise to continue? Manisha, take it away. It's been a sparkling year for gold.
Well, 2019 clearly has turned out a sparkling, very good year for gold as import, as returns and as price movement as well. First of all, look at the demand that in India that has continued to be on the higher side, even as we've seen import duty at record highs of 12.5%. There is a GST and the markets have seen an economic slowdown as well. If you look at the last 5 years, we pretty much have been able to hold average of around 700 tons of import into India. In this year, until now, we have done 650 tons. And the expectation from the global analysts is that between 750 to 800 tons of import is how we will be closing 2019. So the imports pretty much online there. Also, when you look at the India's report card into the international markets, we continue to be the second here in sense of global demand. First, of course, has been China, and that has been for 2 years now, almost 1,000 tons of import happening there, while India continues to maintain between that 700 tons of an average import in last 5 to 6 years. When you look at the overall global demand for gold, there as well, we have seen some strength in the previous and the previous year as well. So when you look at 2017 and 18, the global demand has been inching higher as well. And the expectation is that for 2019, we perhaps are looking at higher numbers onto that. So while we did see 3,200 of global demand in 2017, it has crossed 3,300 in 2018. And the expectation that with the investment demand, ETF buying, sovereign gold bond buying with various gold instruments now out, you will see that demand continue to go higher in 2019. And finally, it all boils down to the price with the kind of returns that we have seen. So while last 5 years have been nothing too much to take home to, this current year has been the best return in last many years. We did see record highs in case of gold in the Indian markets in this year, and not just India, 72 other countries also saw all-time highs in gold in 2019. 17% of gains is what we've seen in the dollar terms, 22% up in the Indian rupees as well, and we still have a few months remaining in this calendar year. The expectation is that we are looking at much higher gold prices going forward from here.
All right, Manisha, thank you so much for that quick analysis on gold. Gentlemen, now I do want to come back to fixed income in a slightly more serious manner, because just when retail investors were thinking beyond fixed deposits, they wanted smarter returns, this whole mess came upon us. So to go back to the point that you're making, for a simple retail investor, does it even make sense to look beyond, a tried and tested vehicle like an FD? And if yes, what are the kind of debt funds that you would advise them to look at?
See, I've always debated this comparison of FD to fixed income mutual funds. The same investor knows that he invests in equity because there is diversification. He does not realize that in debt he is also getting the same diversification against investing in one company in FD. So that has to be kept in mind when it comes to investing in a mutual fund. It's a diversified pool of funds. So that differentiates FD from mutual funds. We are a far safer sort of mode, and the recent credit issues have brought up that safety issue. If you were invested all your money in one such company, vis-a-vis invested in a company which carried some part of that company in the portfolio, you won't lose that much, right? So that debate I want to put at rest.
But the question is, obviously, that what we learned this year was that your capital is not protected. It's not a capital protected instrument.
It is never protected anywhere. Today the banks are also
now, yes.
I mean, so let's face that reality. Having said that, going forward, I do pray and hope that we talk about the risks associated in debt in the equal level in which we have talked about the risks associated in equity for the last 20-25 years.
Absolutely. Now, Ashish, on fixed income funds, what are you recommending? Because this could be sort of could be sort of playing with fire here if you do not understand the risks.
See, as I mentioned earlier, I think for any asset class as well, you need to have a framework. So I have the rule of 3 for our investors today. Okay, the rule of 3 is basically you invest in fixed income for 3 reasons. One is liquidity. The money that you need anytime, overnight, needs to be kept either in a liquid fund or a bank deposit. It also gives you a lot of peace of mind, whether we like it or no. The second part of your portfolio is income, which is where bonds come in, like tax-free bonds or the PSU debt funds, which are basically accruing returns at the interest rate. So today the PSU debt funds are trading at about 7%. So if you invest for 3 years, you make your 7%. And the third portion of your portfolio is the alpha portfolio, where you're trying to make a little extra. Now there are only 2 ways you can make a little extra in fixed income. Either you go down the credit curve, so you buy a AA or a single A bond to make a little extra return, or you predict the interest rate moves. So if, like Swarup was saying, if interest rates are really going to go down by 100 basis points, then a gilt fund will give you that extra return.
So do you think that continuing to invest in gilt funds will still work this year as well?
No. So our view is that for most investors who cannot bear the volatility in their fixed income portfolio, they're better off trying to make the extra returns through credit funds. Now, I know last 3 years credit funds have not worked, but even today, if you look at the average return of credit funds, some of the bigger credit funds, it's about close to 5-6%. So you've not made an alpha, but you've also not lost money. Compare this with people who put money in NCDs, single NCDs, and have lost all the capital.
True.
So it's still giving you that diversification benefit.
Kalpen, do you agree?
So my personal investing belief for a retail investor is if you're not in the high tax bracket, FDs are simple and safer for you, number one, even though, I hate a mutual fund. And if taxation, tax efficiency is valuable, if you are in the higher tax bracket, then a simple short-term fund which buys 2 to 3 year corporate bonds is like a diversified equity fund. It does not give you too much of worries about how interest rates move and how credits move, because for all these worries over a full life of 10-20 years you'll make 0.5% or 1% more. You rather optimize that through equity. So I prefer keep it simple.
Okay. So, gentlemen, we've come to the end of this very interesting conversation, and as always, I'm going to ask you for that one Diwali wealth creation tip that you'd like to share with our viewers. Swarup?
I think stick to asset allocation. These are great times to invest in India. Look at both asset classes that are on offer from mutual funds. The only thing is, when you look at asset allocation, add your entire investment pool rather than just look at the part which is in mutual fund.
Kalpen, your one wealth creation tip.
Always think of where can you lose money. And then build your portfolio. It will hold you in better stead than doing the opposite, which is seek past high performing returns.
Okay, those are loaded words, heavy words, and words that you really need to keep in mind. Ashish, your advice?
So my advice is rule of 3 plus gold. So rule of 3 is basically growth, which is satisfied by equities as an asset class, income, which is satisfied by debt funds, and liquidity, which is where you keep some money in bank deposits, and plus gold, because gold is an asset which gives you an insurance against any untoward incident or unpredictable events that unfold globally as well as domestically.
Well, we've seen several of those events unfold in the last 12 months. Let's see what the next 1 year brings. But we wish you, gentlemen, a very, very happy Diwali and a prosperous new year. And a big thank you for joining us on this special edition of Money, Money, Money.
Thank you very much.
All right, viewers, thank you very much for joining in as well. Of course, throughout the course of the year, we will keep getting you more insights, more ideas for wealth creation and preservation. Season's greetings to all of you.